The American debt crisis is getting out of control, with a staggering $36.22 trillion as of April 2025. And you might already be watching a ton of news about it. But what happens if the world actually stops funding America's borrowing habit? Why does no country want to buy America's debt anymore? And how would it impact the global economy? In this video, I'm going to explain everything in detail. But first, let's understand basics. What does it mean when I say, no one's buying America's debt? Part 1. What does buying America's debt mean? Let's imagine that your friend Sam keeps borrowing money from everyone in the neighborhood. At first, everyone's cool with it, because Sam always pays back on time and he's got a steady job. He's the kind of guy you trust with your money. But over time, his debts keep piling up, he starts borrowing even more, and people begin to wonder, what if he can't pay it all back? And that's why people are losing trust and no longer lending money to him. Now, consider Sam as the US government. For decades, the US has been borrowing money from all over the world, but in a very official way. Countries like China and Japan used to buy US Treasury bonds. These bonds were like agreements that said, lend us your money now, and we'll pay you back later with a bit of interest. But why would other countries want to buy debt as treasuries? Because the US Treasuries were considered one of the safest investments on Earth. The US had never defaulted, its economy was strong, and the US dollar was the globally dominant currency. So this system of buying debt gave countries like China, Japan, etc., a super safe place to store their wealth. Plus, buying US debt helped them keep the value of the dollar strong relative to their own currency, which made their exports cheaper and more attractive to American consumers. While for the US, this debt system provided a steady flow of money to help fund government spending, everything from roads to defense to social programs. It could borrow cheaply because everyone wanted those treasury bonds. That was a win-win situation for both sides. But now, things have shifted dramatically. Countries are no longer buying US debt like they used to. Instead, they are cashing in on some of those agreements, selling bonds and using the money in their own countries. The world's faith in the US economy is shaking, and it's raising big questions about what happens when fewer people want to lend money to the US. Now let's find out the extent of America's current debt. Part 2. How much is America's debt? Well, a national debt is basically all the money that the government has borrowed over time and hasn't paid back yet. Right now, America is literally crushed under the weight of its debt. Every child born in America today inherits approximately $103,000 in federal debt. That's like giving every newborn a mortgage, but without the house. Not only that, but if we split the debt among every US household, each family would owe over $150,000, which is worse than ever. Such a huge debt has also increased the debt to GDP ratio, which is now over 125%. This debt to GDP ratio is a comparison between what a country owes and what it produces economically in a year. So imagine if you owed $125,000 in credit card debt but only earned $100,000 per year. That must be insane, right? This is the current situation of America, but what could have possibly gone wrong? Part 3. Why no country wants to buy America's debt? If we look back to 2011, America's credit rating was downgraded for the first time in history because of concerns about the debt. A credit rating is like a report card for how trustworthy a country is with money. If your grade drops, fewer people want to lend you money. Because of that, countries that used to eagerly buy US debt are now starting to back away. Countries like Japan and China, which have been huge buyers of US debt, are now lacking trust in the US economy. At one point, these countries owned about 33% of all US Treasury bonds, because those bonds were considered the safest and the most reliable investment options in the world until the number dropped to less than 24%, which means over $2 trillion in purchasing power had disappeared from the market just because of the debt that the US has to pay. Surprisingly, China, which used to hold about $1.3 trillion in US Treasury bonds, has now reduced its holdings to around $760 billion. That's quite a huge drop of over $540 billion. The same is the case with the US's largest foreign debt holder, Japan, which is also reducing its position in the debt scenario of America. The recent stats published by the US government shocked the masses when they officially declared that the government is spending more money on interest payments than on the military. Specifically, interest payments were projected to reach $870 billion, while national defense spending was projected to be $822 billion. This marked a significant shift, as interest costs have been rapidly increasing. And trust me, this has never been the case before. Indeed, it is insanely dramatic to see that all of the US money is draining into paying the interest on debt, and not even in reducing the debt itself. It's like a vicious cycle of higher interest rates and higher payments, which means more borrowing and paying even more interest, an interest that is not going to end, even in decades. Another reason for this downfall is the failed Treasury auction. Treasury auction is a sale where the government tries to find countries willing to lend it money by buying Treasury bonds. Recently, these auctions have been showing some really scary signs. The bid-to-cover ratio for Treasury bonds has hit historic lows. The bid-to-cover ratio measures how many people want to buy the debt compared to how much is available. And shockingly, in February 2025, a major 10-year Treasury note auction had a bid-to-cover ratio of just 2.1. This was below normal. That means fewer buyers were showing up at the auction. In March 2025, something even scarier happened. There weren't enough buyers for all the bonds being sold. This was called an uncovered auction, and it was rare and humiliating for superpower like the US. It's like putting your house up for sale and nobody makes an offer at your asking price. When this happens, the Federal Reserve has to step in and buy the leftover bonds, which is basically like printing money to pay the bills. Think of it like this: if you're selling a house and get 10 offers, that's great. But if you only get one offer, that's concerning because you don't really have options. That's how endangered America is right now. In addition, inflation in America is something that can't be ignored. But why does this rise in prices over time matter for debt? Well, imagine lending someone $100 with the promise they'll pay you back $102 next year. Sounds good, right? But what if prices rise by 5% during that year? That means your $102 will only buy what $97 would have bought a year ago. You've actually lost money in real terms. This is exactly what's happening with US Treasury bonds. If the interest rate on the bond is lower than the inflation rate, investors lose purchasing power. No wonder they're looking elsewhere. Even though official numbers say a decline in inflation, which is around 2.39% now, still many investors are looking away as they don't believe that these numbers reflect reality. For example, in early 2022, the 10-year Treasury bond paid about 1.5% interest while inflation was running over 7%. That means investors were losing about 5.5% of their money's value every year, which was a terrible deal strategically. And let's not forget that the dollar dominance period is now fading. The US dollar has been dominating the world for almost 80 years because it was accepted all around the world, and countries used it for international trade and kept it in their banks as a safety net. This special status created a natural demand for US Treasury bonds, as countries needed dollars and wanted safe places to store them. But this is also changing fast. In March 2025, the percentage of global foreign exchange reserves held in dollars fell below 55% for the first time since 1944, down from over 70% just 20 years ago. This means countries are moving away from the dollar and looking at alternatives. Countries like Brazil, Russia, India, China, and South Africa have been creating their payment systems to reduce dependence on the dollar. China has launched the digital yuan, and more countries are trading directly in their currencies instead of using dollars as an intermediary. Also, China and other BRICS countries like Brazil, Russia, and India are trying to reduce their reliance on the US dollar altogether. They're building alternative systems, using their own currencies, and even buying gold instead of American debt. Why? Because they don't want to be tied too closely to America's economy, especially if they don't trust where it's headed. It's like being the most popular kid in school for decades, then suddenly noticing everyone's starting to hang out with other people. So basically, America's dollar dominance is fading and losing its charm. Part 4. Geopolitical Shift and its Impact. To make things even worse, Donald Trump went all in with new tariffs. Tariffs are taxes on goods coming into the US. First, a 104% tariff on Chinese products. China clapped back with an 84% tariff on US goods. And just like that, the trade war went nuclear. Then Trump hiked the tariff again, this time to 125%. China has reduced its holdings of U.S. Treasury bonds by over $400 billion since 2021. This isn't just a financial decision, but also a strategic message. By selling U.S. debt, China signals that it's not afraid to use its financial power as a bargaining chip. Not only China, but Saudi Arabia also showed up. Now they don't use their money to buy U.S. Treasury bonds. Instead, Saudi Arabia has reduced its U.S. Treasury holdings by 30%, while increasing investments in Chinese and European bonds. However, Trump paused some of those tariffs for 90 days and offered slightly better terms to a few other countries, and the markets briefly calmed down. But the damage was already done. Now here's the scary part. The interest rate the U.S. has to pay to borrow money, that's the yield on those bonds, spiked from 3.9% to 4.5%. That's the highest it's been since February 2025, and it's a red flag. When bond yields go up, it means the price of the bonds is going down, because people are selling them like hot potatoes. Investors are basically saying, nope, we don't trust this anymore. Even economists are sounding alarms. They're worried these tariffs will make goods more expensive, which means inflation could rise, and that could seriously hurt businesses. If it costs more to borrow money and more to import goods, what happens? Companies start to cut back, jobs get slashed, the economy slows down. Even JP Morgan predicted that there's a 60% chance the US goes into recession. That's up from 40%. One economist even said, it's basically a coin toss now. That's a 50-50 chance. So what does this all mean? It means the world's biggest economy is entering a very uncertain, very fragile phase. A trade war meant to protect American jobs could end up destroying them. And investors, they've stopped seeing US bonds as a safe haven. That alone tells you everything. But is it a full-blown recession on its way? Well, we're not at the edge of collapse yet. But if these trends continue, the global financial system could fall fast. The question now is, can America regain the world's trust before it's too late? Thanks for watching. Let me know what you think in the comments below, and don't forget to like and subscribe for more breakdowns like this.